Let's talk about something pretty wild that happened in the crypto world. Now, we all know things can get volatile, right? But every now and then something happens that just makes everyone stop and stare. Today, we're breaking down one of those moments, a massive market meltdown, and XRP was right at the center of it.
So this is the number that kicks off our whole story. 93%. I mean, just look at it. It's a huge, kind of scary figure that points to something going very, very wrong, very, very fast.
And get this. This all happened in the span of a single day. A 903% imbalance, popping up in just 24 hours. Honestly, the speed of it is almost as shocking as the number itself.
So you're probably looking at that and thinking, what on earth does that even mean for the market? What does a number like that really tell us about the risks that are, hiding just below the surface? But let's get into it.
All right, first things first, we have to unpack this headline number. What are we actually talking about when we say a liquidation imbalance?
Okay, so think of it like a massive tug-of-war. You've got the longs, traders betting the price will go up, and the shorts, traders betting it'll go down. A liquidation is when the market moves against you so hard, the exchange just force closes your position to stop the bleeding. So an imbalance this big means one side didn't just lose the tug-of-war. They got absolutely demolished. And to really see how insane this was, just look at this comparison. Bitcoin and Ethereum, yeah, they had some pretty big imbalances, around 100, 200%. But XRP at 903%, it's not even in the same league. This wasn't just a bad day for the market. This was something else entirely, focused right on XRP.
Now, this isn't just numbers on a screen. We are talking about real money, folks. On that one day, over $7.2 million from traders betting on XRP to go up just vanished. Poof. It was a complete bloodbath for the bulls.
And when you look at who got hit, it's pretty revealing. A staggering 93% of everyone who got liquidated were the longs. This screams overconfidence. It looks like a huge crowd of people all made the same bet that the price would rise, and they probably took on way too much risk. When the tide turned, they all went down together.
So, the big question is, why? How does something like this even happen? Well, it wasn't just a random bit of bad luck. It was more like a perfect storm of bad conditions all coming together to create one heck of a vicious cycle. And this cycle was built on three main pillars. First, you had way more sellers than buyers. Second, you had this thing called thin liquidity, which we'll get into. And third, you had some, let's call it, interesting activity from the big money institutional players. This idea of thin liquidity is so important. Imagine a really shallow swimming pool. If you jump in, you're going to make a huge splash, right? That's kind of like XRP's market. With only about 20% of all XRP actually available to trade, any big sell-off is like jumping in that shallow pool. It causes these massive price waves that just wouldn't happen in a deeper, more liquid market.
And here's where the plot thickens. While all these everyday traders were getting wiped out, some analysts think the big institutions were actually pushing the price down on purpose. Why would they do that? Well, maybe to scoop up a bunch of XRP for cheap. They essentially turned the panic of the little guy into a big opportunity for themselves.
Okay, so now we get the why. The market was basically a tinderbox waiting for a spark. But let's look at the how. How did so many people lose so much money so quickly? The answer is a single, very powerful word: leverage.
You've probably heard the term, but leverage is basically using borrowed money to make a much bigger bet. It's like you're putting down $1 to control $100. It can multiply your wins like crazy, but as we saw here, it can also multiply your losses into a total catastrophe. It's playing with fire.
And the difference is just it's night and day. Look at this. If you're conservative using 5x leverage, you can handle a pretty big 20% price drop before you're in trouble. But if you're aggressive using 100x leverage, the price only has to move against you by 1%, one tiny percent, and you're wiped out. That's exactly what happened to all those XRP traders.
And if that wasn't bad enough, many exchanges have a feature called cross margin that acted like gasoline on the fire. It means that when your XRP trade started going bad, the exchange didn't just close that one position. It started using the money from your other crypto investments to cover the losses, creating this horrible domino effect that could liquidate your entire account.
Whew, okay. So we've seen what happened and how it all went down. But what's the lesson here? What do we do with this information? Well, this whole event is a massive cautionary tale. And from it, we can actually pull out some really clear rules for how to survive out there.
And the survival guide is pretty straightforward, but you've got to have discipline.
Number 1, control your leverage. Just keep it low, like 2x to 5x. Number 2, and this is the big one, use a stop loss. Decide how much you're willing to lose before you even make the trade. 3, think about hedging your bets to protect yourself. And 4, keep a close eye on those funding rates because they can quietly eat up all your profits.
Just think about this for a second. In the middle of this exact crisis, a trader who simply had an automatic sell order, a stop loss, set for just a 2% loss, would have gotten out super early. They would have saved almost all of their money while everyone else was watching their accounts go to zero. It's the seatbelt of trading. You just have to use it. So after all that drama, what's next for XRP? Is it a damaged asset, or was this just a really painful learning experience on a much longer journey? The truth is, the future looks, well, it looks like it could go one of two ways.
You've really got two completely different stories being told about XRP at the same time. The bulls will point to huge institutional adoption. We're talking ETFs from ProShares, services from banking giants like BNY Mellon, and futures volume going through the roof. But the bears are still worried. There's this constant regulatory cloud hanging over XRP, and that uncertainty really spooks the market and holds the price back.
Which leaves us with the final million-dollar question. Is XRP a coiled spring, just building up all this institutional pressure before it explodes upward? Or is this 903% meltdown a massive red flag, a cautionary tale about an asset with some deep-seated problems? The answer to that is probably going to define the next chapter for XRP, and you can bet everyone is watching to see which way it breaks.